Back in March, we covered Trulieve, a company doing $1.2 billion in revenue at a 60% gross margin, generating record cash flow, that still reported a loss, purely because a tax code written for drug traffickers taxed it at 228%. Back then, it was a $6 over-the-counter stock, and the fix was just a promise. 3 months later, the promise is getting real. Trulieve is now the first U.S. cannabis company ever on the New York Stock Exchange. Its quarterly tax rate just collapsed from 258% to 87%, and the stock is up more than 50%. So here's the real question. For years, this was a cash machine that couldn't show a profit. Now, the tax is lifting. What does Trulieve do with the profitability it hasn't had in years? First, the shape of the business. Revenue peaked at about $1.2 billion back in 2022, then settled into a plateau. Fiscal 2025 was $1.2 billion, essentially flat year over year, and the first quarter of 2026 came in about 3.5% lower. But traffic and units each rose about 5%. This is a price story, not a demand story. The interesting part of Trulieve isn't the top line, it's everything below it. Here is the number that defines cannabis investing. In fiscal 2025, Trulieve had positive pre-tax income of $91 million. Its income tax bill was $208 million. That is an effective tax rate of 228%. The culprit is Section 280E of the tax code, which bars a federally illegal business from deducting any expense except cost of goods sold. So the tax is calculated on gross profit, not net profit, and Trulieve owes it even in years it loses money on the books. Strip away the tax line, and this is a genuinely good business. Gross margin held at 60%, the best of any large operator. Adjusted EBITDA was a record $427 million, a 36% margin. Operating cash flow was a record $273 million, and free cash flow a record $229 million. That's about a 12% free cash flow yield on today's market value. And yet the company reported a $116 million net loss. The gap between those two facts is almost entirely the tax line. And this isn't one bad year. Look across 5 years. From 2021 through 2025, Trulieve paid or accrued $866 million in income taxes on cumulative pre-tax income of just $7 million. In 2024, the effective rate was 463%. The company was profitable before tax in 3 of those 5 years and still bled cash to the IRS every single year. That is Section 280E. It is not a headwind. It is the entire weather system. Put a dollar figure on it. If Trulieve were taxed like a normal company, at roughly 25% on its $91 million of pre-tax income, it would owe about $23 million. It owed $208 million. The difference, $185 million a year, is the Section 280E penalty. That is the single largest line item standing between Trulieve and clean profitability. And as of 2026, it is starting to come off. So what does the company look like when the switch flips? Apply a normal 25% tax rate to that $91 million of pre-tax income, and the $116 million loss becomes about $69 million of profit, a $185 million swing. Now, add back the $66 million Trulieve spent on the failed Florida ballot campaign, a cost that cannot recur because Florida adult use is dead until 2028, and normalized earnings rise to about $118 million. That's 57 cents a share, an implied 17 times earnings at today's price, versus a reported loss. And this is not hypothetical. A partial, medical-only rescheduling to Schedule 3 took effect in April 2026, and you can already see it in the first quarter. Trulieve's effective tax rate fell from 258% a year earlier to 87%. The company posted positive net income of $2.4 million, its first profitable quarter on a reported basis in years, and it did that on lower revenue. That's not a forecast. It's already on the books. That medical profile is also why Trulieve, and not a bigger rival, got onto the New York Stock Exchange first. Relief today applies only to medical income. Trulieve is mostly medical and Florida dominant, so it deconsolidated its mixed-use operations into a separate company called Harvest Enterprises, leaving the listed entity as a clean, medical-only operator. An outside investor took a 10% stake in Harvest for $14.8 million. The result, ticker TRLV, is the first plant-touching cannabis company on a major American exchange, and the cleanest 280E relief profile in the sector. So here's the question that actually matters now. For years, Trulieve generated cash, but could never show a profit. As Section 280E lifts, that flips. The company already throws off $229 million in free cash flow, holds $256 million in cash against just $232 million in debt, and has authorized a $50 million buyback. In a sector where rivals are being handed to their creditors, Trulieve is the rare operator with a clean balance sheet and real firepower. That makes it a buyer, not a target. Newfound profitability doesn't just flatter the income statement. It funds buybacks, acquisitions, and expansion, while everyone else is forced to sell. So what is it worth as a normal business? Today, Trulieve trades around $9, roughly 5 times adjusted EBITDA, with a free cash flow yield around 12%. A discounted cash flow that assumes 280E persists on adult use lands around $8 to $10, right about where it trades. A version that assumes broad rescheduling removes the tax entirely lands in the low to mid-teens. And if it's simply re-rated to the 8 to 12 times EBITDA that comparable consumer staples businesses get, the implied value is roughly $16 to $24. So at today's price, the market is paying for medical relief and essentially nothing else. This is implied value, understated assumptions. It is not a price target. And here is the honest bull and bear. The bull case. First mover on the New York Stock Exchange. Medical 280E relief landing now. $229 million of free cash flow. And a clean balance sheet that makes Trulieve a buyer, not a target. The bear case is just as concrete. The partial rescheduling order is under a pending appeal that could undo it. The June 29th Drug Enforcement Administration hearing on broad rescheduling was stacked entirely with opponents. Florida adult use is dead until 2028. Trulieve is one of 9 operators named in Ohio's antitrust suit, and a $696 million back tax reserve is still growing. Going forward relief does not erase that bill. Here's the framework. Trulieve is a 60% gross margin, free cash flow, positive market leader whose only real problem is a tax code, and it has already proven it can restructure to capture the fix. What it's worth depends on how far the policy goes, not on the operations. So watch 5 things: the court ruling on the rescheduling stay, the June 29th hearing on broad rescheduling, the quarterly tax rate, and Florida pricing, how management deploys its newfound free cash flow, and that $696 million back tax reserve. The data says this is a real, profitable business hiding behind a punitive tax rate. You decide what that's worth. This entire analysis was built using RoboSystems, an open source platform that gives you direct access to structured SEC filing data for every public company: revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. You can set up the same tools I just used in about 5 minutes. Head to robosystems.ai to get started. Link in the description.